If you have access to an employee stock ownership plan, there is a strategy available to you that you may or may not be aware of. It's called Net Unrealized Appreciation. Now, it's NUA for short. In reality, what this actually means is if you work for this company and they provide you stock in the company, when you retire or at certain milestones, you have options to create favorable tax treatment of these shares. That's what today's video is all about. So if you want to learn about that, stick around. If you're new here, my name is Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner. My goal with these videos is to help you retire with confidence. They're not meant to be personal, financial, tax, or investment advice. They're just for education. So let's start by defining what is net unrealized appreciation. I'm going to break this down for you, and I'm going to explain to you what the basic rules are of utilizing it. When might you want to do this and when might you not want to do this? That's really what it boils down to, and maybe how this could fit into a larger financial planning scenario. So let's get into it. Net unrealized appreciation. So for those that have shares in an employee stock ownership plan, the way this works is the company just gives you the shares. So let's say you work there for 20 to 30 years. Let's say that you accumulate a certain number of shares, and over time, when they grant you those shares, they're going to be at a certain share price. Now that's going to change over time, and how many shares you get at the share price you got them at is called your cost basis. So let's just use some simple math. Let's say that you worked at this company for 30 years and you have accumulated $50,000 worth of cost basis shares. Now, the good news is the company's done really well. And as you're approaching retirement or you're thinking about retirement, now those shares that were at a cost of $50,000, to be fair, you didn't pay the cost. They were given to you at a certain cost, but it's going to be imputed to you. So that is your cost basis, $50,000. Let's say it went from $50,000 to $500,000. That is great news. That means your employee stock ownership plan that you own went up $450,000. Now here's where this strategy comes in. If you didn't watch this video or you have no idea what net unrealized appreciation is, say it's your last day at work, you're saying goodbye to everyone, you just walked out of your party, you call your HR, you do a rollover of your 401k plan to your new IRA. Pretty common. Either you leave it there or you send it to an IRA. Those are the two most common things that would happen. The problem is those are stock shares. And if you know anything about stock, you'll know that when you sell stock, it's subject to capital gains rates, which depending on your ordinary income in the years you sell is either going to be 0 or 15%. In a majority of cases, it can be 20 and a little bit more, depending if you're subject to something called the net investment income tax. But in vast majority of retirees are going to pay either 0 or 15% on those capital gains. The problem is, if you put that stock into an IRA, although the taxes are deferred, they're going to be paid at your ordinary income rate. So if you know your ordinary income rate in retirement is going to be over 15%, it may make sense for you to utilize the net unrealized appreciation strategy. Now, that's in a nutshell what you're actually doing is you are transforming something that could be paid at ordinary income rates into capital gains rates. Now there are some caveats. What are the rules? So let's start with them. First, you have to attain what's called a triggering event. So a triggering event could either be death of the worker, separation from service, attaining the age 59 and a half. Those are the 3 triggering events. So for most people, it's going to be a combination. So I also want to be clear, just because you reached a triggering event does not mean you have to execute NUA in that year that you reached it. It just means you at least have to reach the triggering event before you do it. For most people, it will coincide. So that's the first strategy. The second thing is you have to do what's called an in-kind distribution of the company shares. Simply put, all the shares with their individual lots. Remember, cost basis is the number of shares you bought and the price associated with them. They need to move over just as they were into a taxable brokerage account, because remember, we don't want to put it in an IRA. That would help mitigate that tax arbitrage. The IRA wouldn't make it come out at ordinary income. We want it to be in a taxable brokerage account. And the third thing is, in the year that NUA strategy is executed, the entire value of that 401k account has to be distributed in lump sum. Now, that doesn't mean that every single share you have of your company's stock has to go into the brokerage account. You can actually choose the most favorable ones. And I'm going to get to that in just a second when I say when might you want to do this and when would you not want to do this. So those are really the rules. Now, let's move on and let's say, how is this actually going to be taxed? So there's three portions that we need to understand here. I already mentioned what I called the cost basis. So going back to our example, in this case, the worker has $50,000. Let's call him Bob. Bob has $50,000 of cost basis in the stock. There is a new value of $500,000. So another way to say this would be the net unrealized appreciation is $450,000. Now there's a third type here, which is after you move the stock, any movement that happens after it already hits that new account is a different type of tax treatment. So let me go through the three. The downside, the one downside, and when you need to really do some calculations here, is when you do net unrealized appreciation as part of this strategy, in the year that you move those shares into the taxable brokerage account, it is going to be taxed as ordinary income. So let's just say Bob worked that year and he made $100,000. If he moves the shares that have a cost basis of $50,000, guess what? In the IRS's eyes, he made $150,000. He adds $50,000 to his ordinary income for the year. Now, why would you do that, you ask? The reason is the long-term benefit of having capital gains treatment on the $450,000 may outweigh the tax you pay up front as ordinary income on the $50,000. So I want you to understand that. Now, you don't have to sell the shares. You just can move them in kind, and no matter how long you hold them, the difference between your cost basis and the total amount, which in this case is $500,000, the $450,000 will always be taxed as long-term capital gains. Now, again, this could be a strategic planning move. Depending on where you know your ordinary income will be in retirement, you may want to sell them immediately, or you may want to sell them later. So when might you want to take advantage of this? So here's one example. When you have low cost basis and you have a high amount of growth, right? Makes sense. Let's say those numbers were different. Let's say it was $10,000 and the growth was $500,000. It's not that big of a deal for most people to take a $10,000 ordinary income. Sometimes that's less than a quarterly bonus, depending on where you work and what you do. So taking that income hit in the front end may be more than worth it to take the $450,000 and decide when you want to take that in the form of long-term capital gains. Now, another thing I want to specify here is the other reason you may want to do this is because of the timing. So this would be best utilized at the beginning of a year. Here's why. Let's say that you retired and you're going to do all this at once. You're going to do it all in 1 year. You have the $50,000, you have the $450,000. That is the net unrealized appreciation. And let's just say that for the sake of our argument here, we go ahead and we say that we have $50,000 that we're going to add to our income. If we retire in January, then we have $450,000 in a brokerage account, and we could then start to live on that. And again, if you've seen some of my videos and you're familiar with this, you could then actually pay 0% capital gains as you're selling and diversifying out of that company stock in the first year you retire. That could be a great strategy. Now, when would you not want to do this? In reality, the easiest thing and decision to make here would be, what is the relative cost basis versus the growth of the stock? Now, if you don't have a low cost basis, you would not want to choose those shares for NUA treatment. So remember what I said. This doesn't have to be all or nothing. Now, in some cases, things may just not have panned out the way you thought. So your cost basis is very close to what the growth of the stock ended up being. In that case, you're better off just deferring the taxes and rolling this over into an IRA. Now, Typically, I do a more in-depth case study. In this case, I just wanted you to understand net unrealized appreciation, but please, I'd love to hear your comments. I'd love to know if you're familiar with this strategy. When would you utilize it, and what role do you see it playing in early retirement planning? As always, comment and subscribe, and I will see you on the next video.